Welcome to Investing for Kids. I get this question all the time. I have an almost 2-year-old daughter, so I completely get it. And if you're listening to this, you probably have an inkling feeling that time is where you make the most money. Compound interest is this magical thing that creates all the wealth for us. So if you're investing for your kid from even age 2, even age 10, you are way, way, way ahead of if you're only starting at age 30. Like that's at least 2 decades of compounding money, which is incredible. Well done, you. So this is for if you're investing in the US. I have full separate trainings on Australia and the UK because these are the 3 regions that I teach. Now, if you are outside of the US, then listen to your relevant country. Second point, if you are listening on the podcast, then you might want to tune into this video because I'm going to be showing you a few things on screen. The third point is I'm going to be going through different options on how to invest for kids, but I'm not going to be talking about what to invest in because that's a whole other thing. So if you want that training, I have a guide that walks you through step by step how to invest in the stock market. I also have a full program called Invested where I handhold you through the whole way. It's the same strategy, even if you're busy, even if you're a beginner. So if you want to get like really clear, confident, and like all of that clarity around your finances and your financial future and setting up your kids for like really becoming a millionaire. And I'm going to show you what that looks like in a minute. Then I'll put all that info in the show notes. Okay, so let's actually first look at how much this could build to for your kids, because what you put in and also what you invest in will have a massive impact on the actual return at the end. And you might think that right now, even $50 a week or $100 a month is not that much, but because you're leaving it for so long, time is your best friend here. So the earlier you start, the better. And look, I always like to say the best time to invest is like 10 years ago. The second best time is now. But I also don't want to create this like anxiety within people of thinking that it's too late because that's not the case. So I sort of want to urge you to do it as fast as possible, but I don't want to shame you into thinking that it's like too late and you've missed the mark. Somewhere in the middle is a nice balance. Okay, let's share my screen. I'm going to show you what it looks like. And you can play with this tool yourself and look at the different numbers. You can look at different returns. And again, that depends on what you invest in. It also depends on different countries. There's a whole range of stuff to know and to think about. Which again is not what I'm going to talk about today because there is so much to cover and I only wanted to get this quickly out to you. I also have to pick up my daughter from daycare in a minute. So I'm trying to get this out to you in the most efficient way possible. Okay, so here is it's called a compound interest calculator. Now, I don't think that this is the best term for it. It really should be like called an investment return or investment compound calculator because it shows you what you get in savings at the end. But really, let's be real. What we're talking about here is total investment portfolio value at the end. So I'm going to change this to 8 almost 9%. Now, that is less than the average return of the stock market year on year if you measure it over 10, 20, 30, 40 years. If you're investing in more conservative assets, then you can drop that down. And I'll show you what that looks like. But again, I know I keep saying this, but it really does depend on what you invest in. So full stocks, for example, like 100% stocks is going to be like what you're looking at the 10. In some countries, even like up to 12, 13% return year on year. Now, of course, the stock market is not a robot. It doesn't return that every single year. Some years it's 25%. Some years it's minus 15. And at the end of the day, you really shouldn't be looking at this daily, monthly, or even yearly if you just set up auto investing, putting it in every year because you know you're leaving it for decades and creating this security, this like sort of buffer, this cushion for your kid to use later on. Okay, so let's just say we put in $50 a week and we do that over 10 years. In 10 years, you're going to have $40,000. It's not a whole, like $200 a month is not that much. And so what you're putting in is 26,000. But If you do that for 20 years, then you have 142,000. So you're starting to see that the growth is not linear. So double the time is triple the money. If we do this for 30 years, it's over $380,000. And you can see here that your actual contribution is quite small, but the growth over time is a lot. So if you started to invest for them, like for example, like my daughter is almost 2, and you started now with a really young child, or even, whatever, your child is about to be born, or it's just a baby. That means at 30 years with only $50 a week, they have over $380,000. That's on average. Now, if you were to invest in more conservative assets, or even like a savings account and, not invest, or invest in like really low, slow growth, but more stable things like bonds, for example, half of that return, or less than half, means that you do over halve your return. So you end up with 150,000. Let's just say it's at 5%, then it's 180,000. Again, play around with this because it's actually quite fun to see. So if we bring it back to roughly that number, I'm still making the effective rate of return less than the average return of the stock market, just to be a little bit more on the conservative side. If you were to increase that to $100 a week, then they end up with over $770,000 in 30 years. So just by increasing it by double, you over double the return. Okay, if you were to leave this for 40 years though, which ideally when they take over it when they're 18, that's most common in most countries, or around about there, depending on the state in the US, and they continue it to when they're 40, they have almost $2 million. And that's probably the best way for me to show you what compound interest or compound return is, because it's not this like, okay, we're just going to double every 10 years. It's actually, oh my God, in 40 years, they can be a multi-millionaire just with $100 a week. Now, let's just drop it down to $50 a week. And over 10 years, you can see that the amount that you're putting in is a pretty large portion of it, but it is small over time. So if we just take that, like say we do that for 10 years and then we leave it, we don't put any more money in, we just put in a total of this $50 a week for 10 years and then we stop. So that means that, let's just say we end up with 41,668. We don't put anything in and we leave it for another 20 years. It means it just still keeps growing. So you still have the base amount that you put in, you don't put in anything else, and it keeps growing for them. So the reason I wanted to show you this is because your situation right now, I know, might change. Maybe you have another child, maybe you go back to work, maybe you stop working, maybe, I don't know, your family dynamics shift, maybe you get divorced, maybe you're going through one or any of those things right now. And I want you to know that whatever the situation you're in right now, it's a season. That's it. It's not going to last forever. And you get to change your mind with what you do with this. So if you're investing now, you're putting money in now, you can pause it for a bit. You can put in a little bit less in the future. You can put in more in the future. But if you start now, even with a small amount that you know is doable, like the power of you starting, building that confidence in your body, actually seeing how possible it is, how easy it is, and how simple you can make it while it's building wealth for you and all your kids in the background. Like, just starting is so much of a confidence builder. Okay, now let's get into actual accounts and what it looks like. All right, now let's look at the actual account options available to you. Now, the US has a couple of really unique things that honestly, because I teach the 3 main countries, US, UK, and Australia, The US is very unique in what they offer in terms of the options that you can grow money tax free in one called a Roth. Now, I'm going to explain a couple of these things and I'm going to assume that you don't know what they are. So, like total beginner, total newbie, maybe you've heard of the term and you don't even know. like, what the hell? What does that mean? Is that an animal? So, let me share my screen. For some people, you learn visually, some learn auditorily, and some learn kinesthetically. So I'm going to be showing you as well as you listening so that it can really like seep in and hit all of the different ways that people learn. Okay, so we have three main different options. So a custodial Roth IRA is basically the same as like a parent Roth IRA. So you contribute after tax dollars, meaning income that you receive after tax, and then you put it into your Roth. And then the great thing is that it grows tax-free. So everything that it continues to grow year on year is completely tax-free. Now, this is very unique. The UK have like something that's sort of similar, but Australia does not. So the fact that you can grow money without having to pay tax on it, like, what? Oh my God. It's a really, really incredible thing. Now, before you say it, I know what you're thinking. After tax dollars means your child has to earn an income. And yes, that is correct. So if you have older kids, this is probably more suited to them. Or if you can structure your home finances in a way where you can pay your child, obviously not a baby if you've just had a little baby, but if you can pay your child for services that work in the business, for example, if you have a business structure, then you can do things in that way. If you don't, and that sounds like way too much hassle, and maybe your kids, whatever, 12, 13, and they're going to be investing, well, you want to start them, you want to get them to have a job soon in the next, whatever, couple of years to start to understand what it's like to own their own money, then you might just want to hold off for this in the meantime, and then you can use one of the other options. But if you have younger kids, then one of the other options is probably the best option for you in the meantime. Now, depending on the state that you're in the US, the assets get transferred to them depending on their age. For some, it's 18. For some, it's 21, which is quite old in terms of what we're talking about. Like when we're talking about investing for kids, I would not call a 21-year-old or a 20-year-old a child. So it depends on the state. So they might qualify if they have a job, or might qualify if you have set up a business structure. So the parent, meaning you, still opens the account and manages the assets for them. Okay. Your second option is a 521 education savings plan. So this is for if you're planning to send them to college and to pay, basically, so their education is paid for. And if you're someone that your family, it really believes in that as part of your values, you really see that as a possibility, then this is an amazing option. I know plenty of people that don't view college as a path. For example, a lot of entrepreneurial families, and they don't believe in college and working for other people. They believe in setting up their own businesses and doing it that way. There's no right way, just by the way, but depending on who you are, what your values are. Now, just because you're that person doesn't mean that your kids are going to be like that, right? I have a 2-year-old and she already has her own mind. So it really does depend. Now, there are benefits to this, even if you're not sure if your child is going to go to college, because you can convert it later on if it's not used, and you can also convert unused funds within this plan if you build it up to eventually be whatever, $10,000, $20,000, $50,000, and it's either not used or only some of it's used, you can convert it. So it's not like you're going to grow this money and then you're just stuck with it and you can't ever be used. It can also be transferred as well. So it can be transferred, for example, to someone else in the family. Then your third one is a UGMA UTMA custodial account. Now, what it stands for is Uniform Gift to Minors Act or Uniform Transfer to Minors Act. That's what it stands for. These codes, I know that it's like one of these investing jargony things that makes it feel way more intimidating, but essentially that's just what it stands for. So again, they're custodial trust accounts, meaning that you are the custodian of this money, of this investment account for them. Now, this is structured slightly different in terms of they get access to it depending on their age, ranging from 18 to 25. Again, I would not consider a 24-year-old a child. But I do also get it because when I was 20, I was $20,000 in debt. So I didn't learn about money, even though my mum scrimped and saved and really she was very good because she had barely not anything, but I didn't learn it because just because somebody is good with or can manage money doesn't mean they know how to teach it, right? So this might be an incredible option to set it up for them so that they can't touch it as well. Okay, so there are different benefits. Let me show you a quick little table. Now, I'm not going to talk about the tax implications because tax is so incredibly complicated. And I'm also not a tax accountant, nor do I want to be one. But there are obviously different tax advantages to a custodial Roth IRA because whilst you're putting in after tax income, you're growing it tax free. And I think that is an incredible thing. Having a Roth IRA as an adult is like an absolute must because growing income, like basically as you saw previously to with the compound interest calculator that I was showing you, eventually you get to the point where you're growing your assets so much that the amount that it's grown is actually earned investment income, not money that you're putting in. So if you're paying tax on that investment income, then that reduces the income that you receive and get to spend. So if you have access to a Roth IRA, then that means you don't pay any tax on that. So that's more income for you. Now, there are contribution limits just as an adult, same as custodial Roth, which is up to $7,000 a year. But for a minor, that would be over $500 a month you'd have to be contributing, meaning that they'd have to be working as earned income after and paying tax to then contribute into the Roth IRA. So for most people, you're probably not going to hit that. So if your child or minor does have earned income, then this is a great option. Otherwise, the other ones are better. A 529, there's a total account limit, but it's like up to $235,000. So let's not worry about that. There are some tax implications on how it's taxed. Again, I'm not going to go into it in detail because I could be here for like 2 hours. And then the UGMA, UTMA is basically there's no limits, right? It's basically a brokerage account, but it's a custodial, like managed for your minor. Now, the fourth option then is a brokerage account. And I only want to reference this or use this as an example because if you have an older teen that isn't yet 25 and you want to learn investing with them or you want to teach them, for example, how to do it so that they can learn from a really young age, like what an incredible skill to teach your teenager and do it with them, then this is a really cool option because some brokers do offer youth accounts. So it's for some, depending on the broker, it's available from 13. And that's old enough to understand compound interest. That's old enough to understand investing and seeing a return. That's old enough to understand you're investing in companies, they pay dividends, they return assets in terms of growth and value, and that's why it's increasing. To teach that is incredible. So this is another option as well, but you're not the custodian of it. So they would own it. So any money that they put into it is obviously owned by them. But I think that creating ownership is a really powerful thing to teach kids and teens. So I wanted to put in that, obviously it's just a standard brokerage account, so it's not like unique or unique to kids, but I think it's worth considering as an option. So you might decide that you end up having all three accounts. In the beginning, you might just have a 529 and a UGMA. And then later, you might add a custodial Roth. Now, I know that feels like a lot of paperwork, but the Roth is always worth it because of the tax-free growth, as I've talked about. A 529, definitely worth it because if you're considering sending your kids to college, then there are definite benefits. And a UGMA is obviously going to stay with them and grow with them for life. So that's also worth it. So that's why they are so different, and that's why they should all be considered. Okay, so that's it. As for what to invest in, as I mentioned, I have a guide that you can get access to. I'll put the access in the show notes. I have a program called Invested. I have so many episodes on the Kiss My Money podcast, so I'll also put that below. And if you're not already following, join me on Instagram where I have lots of videos and trainings and really cool resources for you to use. Okay, see you next time.